Good morning, good morning. What's going on, everybody? Good morning, good evening, good night, depending where you are in the world. Welcome to a Capital Hungry New York scalping session. It is currently 7:20 a.m. Eastern, Wednesday, November 3rd. Today being the Fed interest rate day. That's primarily why we've seen markets ranging overnight. How's everybody doing in the YouTube chat? Okay, looks like the sound and audio and everything is good. So I'm just going to start getting into it. Hopefully everybody gets a chance to read the YouTube description so they understand the process here. I'm not expecting too much today until obviously Fed interest rate, which is at 2 p.m. Eastern, but we're still going to do some analysis across the board on main pairs that we trade, such as XAU USD, gold, precious metal safe haven, GBPJPY, GBP USD, Euro USD, as well as US 30 stock market index. Okay, before we jump into it, remember this is not direct financial advice, but after I give my 2 cents and give analysis, feel free to ask questions about technicals, fundamentals, and overall financial markets. If you want to send TradingView links and have me check out your charts and analysis, I can do that after as well. Do not spam the chat and ask for direct signals. Any questions about the Capital Hungry private service, just go to capitalhungry.com or message me on Telegram. All of your Capital Hungry free resources are linked in multiple areas, from the description to the YouTube layout to the stream reminder page itself. The Capital Hungry news Twitter, Capital Hungry free Telegram analysis channel, and of course this YouTube page itself, which is filled with hundreds and hundreds of educational webinars. Remember, today is going to be a very busy day later in the afternoon with the Federal Reserve interest rate decision, so volume and volatility will be particularly high at that point. I can see the potential for investors more sitting on the sidelines up until Federal Reserve interest rate. As we've seen so far over Asian session and London session, markets primarily ranging with lower volume and volatility, so that's what is showing me overall. So we have to stay adaptive and understand that. And overall, as manual retail traders, you have to stay as emotionally neutral as possible. And the best way to do this is by having a trading plan and following that trading plan. Because at the end of the day, none of us here are institutional traders or bank traders. We are all manual retail traders who have tons of various factors involved that affect our decision making and execution process. So remember to stay smart, follow your trading plan, follow your risk management plan, focus on your long-term vision, keep emotions out, and this is the best way to avoid crashing your account. So some key fundamental points we have to understand is that it's obviously the start of the new month, so we're having a lot of order flow set up for the new month. For example, GBPJPY, when we look at it, is just doing a pullback from new highs printed to potentially set up higher risk, higher reward buys at better demand zones for the new monthly period, as long as everything stays status quo. We have to focus this week primarily on the Federal Reserve interest rate decision, which is going to give us the most confluence of US dollar movement. And we obviously understand how important the US dollar is as the world reserve currency and world business currency. We also have to focus on the US labor market data at the end of the week, being the non-farm payrolls, unemployment rate, and wages data, as well as other main central bank policy statements that we have in the coming weeks and this week as well. We can see that overall, besides some short-term US dollar strength, global equity markets are still bullish and fairly optimistic across the board. So it looks like investors are still squeezing out their gains into the Christmas rally and to close off the end of the year, just when we're looking at stock markets. economic events that we're focusing on today that we can primarily use to our advantage as well. So at 8:15 a.m. Eastern, we have the US ADP non-farm employment change report. This is just going to be information from the private sector. This report is not nearly as important or high impacting as the actual non-farm payrolls at the end of the week, as this is just reporting from the private sector as already stated. But we can potentially use that to our advantage in like another 45 minutes for a potential short-term scalp on our US dollar pairs and gold if that ADP data is poor, like we are potentially expecting, and we'll look at in a second. But any of the impact from US ADP or the US ISM non-manufacturing, I just made a typo here. The US ISM non-manufacturing is at 10 a.m. Eastern, not 11 a.m. Eastern. So that was just a typo. That's my mistake, but we'll look at that anyways. 10:30 a.m. Eastern, US crude oil inventories reporting. And then the main meat and potatoes is obviously during the afternoon of the New York session at 2 p.m. Eastern with the US FOMC and the Fed interest rate decision, which is obviously going to have the largest impact on the markets. So the FOMC is at 2 p.m. Eastern and the press conference is at 2:30 p.m. Eastern following after the rate decision. Oh, you guys can't hear me? Hello, hello. I'm sorry, I just looked at the chat now. Oh, you guys can hear me, right? Just some people having sound issues. Hopefully I didn't talk and say all that and nobody heard me. It shows that audio is good on my end. Okay, cool. All right, cool. Okay, so let's look at gold then, shall we? So I was talking about this with the private channel when I was doing some macro gold analysis and marking out some scenarios for the Federal Reserve interest rate decision, right? So you can see gold here in this overall higher time frame bearish market structure we have been in. Anytime we print a significant impulsive low, we have these very aggressive pullback phases that can be identified by some more refined corrective bullish market structure that comes up to very key specific supply zones multiple times over and over again before having the next impulsive drop to the potential downside. Right? So what I want people to understand when we're looking at this overall market structure here and here is marking out a few scenarios. So obviously, as the pandemic fear started to subside, we started to get recovery in economic data, go out of the lockdown stages, and more people becoming vaccinated. You can see gold started having these impulsive downside moves, having these pullbacks that would come to this exact same supply zone. So you can see from the high here, we had profit taking by buyers in an impulsive downside move. From the pullback area, we come to this very specific supply zone on the higher time frame around the 1960s. Even when we print this impulsive move to the downside and print a new low, we still have this pullback that comes all the way to that supply zone to collect more orders from the 1960s before continuing down. Same pattern here, you get a bit of a pullback bullish market structure that lasts for that month. Impulsive drop side that goes to print a new low. You can see a pullback that comes to that exact same supply zone. Impulsive drop, this pullback almost comes to that exact same area again, right? But after we peaked this high point in the July period, you can see we started to create some similar market structure to what we had here. We would have an impulsive drop and sellers still be in control in the higher time frame, except this being the new higher time frame supply zone that has been identified, where you're having pullback phases and continuous drops to the potential downside, right? So in my opinion, with the Federal Reserve interest rate, there's two scenarios that can happen. Scenario number one is that the Feds just confirm that they are going to start the tapering. This would be scenario two, actually, because I think scenario one is more of a potential curveball aspect, I like to call it, right? Okay, so what we have been seeing from the Federal Reserve and FOMC every time we have the policy statements in the past months is that they have been getting closer and closer to tightening their policy and tapering off the stimulus support. The last FOMC, we were told that the Feds are going to start the tapering process in November. If that is the case and they start the tapering process, that means that they are starting to combat the very high inflation, as well as bring value and demand back to the US dollar, while also regulating the money supply of the US dollar. This means that the tapering process or interest rate hike talks are all bearish fundamental factors on gold. That's why we have not been able to break above this 1830s price point for an extended period of time. So, and you can see that even when we have these bullish rallies that come from low points, the overall structure still shows us that you have these seller impulsive moves lead to consecutive lows. Once you break out of that structure, you have these impulsive drop side moves that lead to previous lows or new lows being printed, right? If for us to see a straight impulsive drop on gold and see a repetition of these moves to the left and still maintain the overall bearish market structure integrity, the Feds will have to confirm starting tapering today during their FOMC statement. The issue is we have all the criteria that needs to be met to start tapering, which the criteria is high inflation that needs to be managed, all of the economic data, like for example, US labor market data is back to pre-pandemic levels. That's good. US manufacturing, US retail sales, US services sector industry, majority of macro US economic data is back to pre-pandemic levels because there hasn't been anything to disrupt that economic rebound. The only thing prior that was causing any disruptions to economic rebound was lockdowns, but the US has been well out of lockdowns and having more and more people get vaccinated. So the easiest FOMC and the most expected FOMC by everyone is that the Feds are finally going to announce the start of tapering, which would lead to a bullish move on the US dollar and a bearish move on gold here to see the next impulsive drop, like we've seen time and time again. When we don't break that significant supply zone and we break out of the bullish market structure, you have these continuous impulsive drops, right? This pullback we had for the month of October was also setting up the new quarterly order flow as well, okay? So the easiest FOMC is if the Feds say, okay, just like we told you guys the last interest rate decisions, we are going to start tapering. We are also going to be looking at future rate hike schedules to potentially start rate hikes maybe at the end of 2023. The economy is very robust and much stronger. Economic data has rebounded. If the Feds give those confirms like everybody is expecting, then we can expect an impulsive downside move on gold here to break this bullish market structure after rejecting, as we didn't come fully up to the supply zone, to break this bullish market structure and then see your next set of impulsive drops, right? Now, that would be the easiest option, but at the end of the day, this is the Federal Reserve, and the Federal Reserve are a bunch of pricks. So you have to understand the prick factor. Even though all of the criteria for tapering has been met, the Federal Reserve today could throw a curveball, which they will say, hey, you know what? We are not ready to start tapering just yet. We're going to start tapering. I know we said we're going to start tapering in November, but we're actually going to start tapering at the start of 2022 because there's still supply chain issues that exist. If that is the case, I see gold first going bullish up to the 1830s and then fading out that strength to set up better risk versus reward sells from this supply zone here, okay? Which would be a similar situation. As you can see, some of these daily candles that came up to this higher time frame supply zone, and even when I show you guys to the left, you can see we had these strong impulsive daily candles that would be 200, 300, 400 pips large, coming all the way up to this potential supply zone, failing to break, more sell orders institutionally getting collected, and then the next day fading out those buyers and continuing right back down with the overall trend. Do you understand what I'm saying? So I'm going to lay this out in even more detail. And for us to see the Federal Reserve throw a curveball with everybody and their grandma is expecting the Feds to start tapering today. That's just what makes it like, it seems a bit too easy. You know what I mean? And the market, they never make it too easy. So everybody and their grandma, if you go to read like on any articles or see anybody posting about about tapering and FOMC, everybody's expecting them to start tapering and confirm the start of tapering, decreasing bond purchases and asset purchases, right? But it's not out of the ordinary for them to throw a curveball. So look at here, for example, at this supply zone here, right? It's a similar idea where even when you had aggressive downside drops, you still had price come all the way up to these supply zones with very aggressive bullish upside moves, not be able to break that supply zone, and then fading out that strength and having another impulsive drop with sell orders being collected on an institutional perspective, right? Do you understand? So this is what I see when I'm looking at situations for gold. I'm marking out this very, very significant supply zone at the 1830 price point. Scenario 1, which I was also talking to private channel members, is this, okay? Scenario 1, we're gonna call it the curveball. So this means that everyone last FOMC, Fed said November they will start tapering. Everyone expects tapering to start today, like from their confirms. Feds throw curveball and delay tapering Okay, so this, during FOMC and the Fed interest rate decision in the afternoon, if the Feds throw a curveball and go against what they've been telling everybody in the previous FOMCs and what everybody is expecting, and they delay tapering and say, you know what, because of supply chain issues and supply chain bottlenecks, as well as we're not seeing the economy fully recovered to where we want it yet. I know we said the last FOMC we are ready to start tapering, but that is not the case yet. Then what I can see happening is that gold will have an upside move and a continuation on the intraday time frames, bouncing from current areas and going up to 1830s to collect a lot more sell orders to fake out a lot of people as well before continuing down. So what we would take advantage of is if Feds throw the curveball, they talk about supply chain risks, they keep policy as is, and they delay tapering, US dollar will go down and gold will come up to retest this higher time frame supply zone again and go from the 1800s to the 1820s, 1830s. Then in the next day or week, fail to break this area and continue right back down with the bearish impulsive move. As overall, they would be giving still the signals to start tapering in 2022, and we would also follow suit if the economic data at the end of the week, such as jobless claims, non-farm payroll, and unemployment rate is also good. So I could see that the Feds throw a curveball today. They say we're not ready to start tapering due to supply chain issues. So we're not ready to start tapering in November. We're most likely going to start tapering in start of 2022. We're still going to wait a few months and address these supply chain issues and monitor it accordingly. This would lead to an initial impulsive upside move on gold for the day. And then the next daily candle or the next week, we would see rejections in this area, then continuations right back down with this pattern of breaking this corrective structure and having the impulsive move to the downside. Okay? Because everybody from the last FOMCs and from based on the news is expecting the Feds to start policy tightening and to start tapering today. Do you understand? And at the end of the day, this is the Federal Reserve. They are known to throw curveballs. They are known to set up better prices. They are known to go against what they said a prior week, cause a lot of confusion, because at the end of the day, they are the market makers. They're the one who control the supply of the US dollar. And then that has a huge ripple effect on the overall markets, and especially gold as a precious metal, which gold is heavily impacted by this. Because if they say that they are going to delay tapering for the time being, what that shows us is that inflation is still going to stay high, which is a bullish fundamental factor for gold. US dollar will also be weak. US dollar will also be weak because they're going to keep stimulus active for the next few months and not start tapering yet to close off the year, right? And of course, interest rates still being low and not giving any signals towards rate hikes, as they're obviously not even starting tapering yet. If they give those confirms, is also a bullish fundamental factor for gold. So I can see us do a heavy liquidity grab sweep, go up into the 1820s and 1830s. If we get scenario one being the curveball, then the next day or week rejecting that 1830 supply zone and coming right back down again. Does that make sense for everybody for the curveball scenario? Right? And you have to understand, gold does very aggressive pullbacks on the intraday time frames and higher time frames, just like I was showing you guys to the left. I'm just going to delete this off my screen for a second, okay? Because I want to show you guys the same thing here. You have this very strong supply zone being created here, right? Gold does this impulsive drop from the all-time high point, breaks into a new low, has a pullback to this supply zone, fails to break, and then continues down. You have another pullback to the supply zone, but look at some of these daily candles as that come up to the supply zone. They look extremely bullish and extremely strong, and it looks like gold's gonna go to the moon, right? You collect more sell orders from an institutional perspective at that key price point of interest, and then you get faded out, come all the way back down to new lows. Even from here at new lows being printed, gold enters this aggressive pullback stage for almost a full month. You see another very aggressive daily bullish candle that comes all the way up to that supply zone, and again still gets faded out with the overall seller price action intact and goes to new lows, respecting that overall bearish market structure. As from a macro fundamental perspective, we've been coming out of a pandemic state, right? We've had no lockdowns in the US. We've had more people getting vaccinated. We've had economic data recovering. We just needed to get the confirms about Feds on policy tightening. And you can see every time you can also identify this little bit of corrective bullish market structure that ends up breaking as well. Right? So now, when we come here and look at current price action, supply zone, you can see from this point here, after having sell orders collected, we had an impulsive drop and a pullback to this area of interest, creating a very strong institutional supply zone. Every time you came to the supply zone, the daily candle prior would be like a 200, 300 pip candle coming up to this area. Right? You would have this bullish market structure coming from a low point that you could identify. But as you come up to this area, if you still fail to break, you collect those sell orders on an institutional perspective and then still end up breaking the trend and going down back to the lows. Does that make sense? So scenario one fundamentally is if the Feds throw a curveball, everybody's expecting them to start tapering November. They say we're going to delay tapering for the time being. We're going to look at tapering at the start of 2022 because there's still supply chain issues. They still want to see economic data rebounded, yada yada, whatever reason they want to say. Gold for this day and the next day goes bullish to retest 1830s and then fades out that strength because you can see even when you have this aggressive bullish price action, it gets faded out the next day or 2 days later. Right? Does that make sense for everybody or no? Exactly. And they don't want to they want to continue to squeeze their gains on the stock markets as far as possible, and especially to close off the year, going into the Christmas rally and so forth. And everybody and their grandma is expecting the Feds to start tapering today, right? So remember, scenario one, curveball. Okay, so scenario one, the curveball scenario, that means that we're going to see gold respect this bullish market structure. They're going to delay tapering. They're going to say they can't start tapering yet due to supply chain issues. And then we're going to see an upside move on gold for the next day or two up into the 1830s for better high risk, high reward sells from the 1830s for that to get faded out, as they're still going to start looking to taper in 2022. And also if we get stronger NFP and unemployment data at the end of the week, we can see that as a reason to fade out the strength here too. Okay? So scenario one, this would be the impact of scenario one on gold. Gold would go up from roughly 1795s to 1800s, all the way up to 1820s and 1830s, right? Then the next day or two, it would get faded out and we'd continue right back bearish, going down into the 1750s, 1700s over the next period of weeks. Okay? when you're looking at there's a scenario 2. I'm going to explain that in a second. So scenario 1 would lead to the US dollar coming all the way back down to like 93 flat and still maintaining this potential overall bullish market structure from these low points. And it would lead to a spike down on the dollar to revisit this previous high and create a double bottom before continuing up days later. It would be the inverse move of gold. Scenario 1, curveball. Feds delay tapering. They say, sorry, you thought we're going to start. Everybody thought we're starting in November. Psych. Y'all thought. You thought we were going to make it that easy. Psych. We're starting 2022. You know what I mean? That would lead to dollar pushing down, coming to 93, doing a double bottom here. That would lead to gold pushing up above the 1800s, going to the 1820s, 1830s. Okay? Now, scenario number 2. Scenario number 2 is this. Scenario number 2, Feds make it easy. What's that mean? Feds simply confirm starting tapering November. Feds give interest rate hike schedules for future. Feds talk in optimistic tone. Feds talk in optimistic tone of economic recovery, economy being strong, and so forth. This equals gold drop and US dollar strength. If scenario 2 happens and the Feds make it easy, we're maybe going to get a quick little liquidity grab up and just a drop. We're just going to see the impulsive drop and break out of this structure. If Feds make it easy and they confirm what they're talking about, if Feds, because for the last months they've said, okay, November we're going to start tapering. If labor market data is rebounded, if more people are vaccinated, if the economy is showing higher potential of recovery, November we're going to start tapering the asset and bond purchases, and that's it. If the Feds confirm that today and say, you know what, we are starting tapering today. We're also going to be looking at interest rate hikes end of 2023. We're also very optimistic with the economic data and recovery. Supply chain issues are not that big of a deal. They talk about the economy being stronger. They talk more in an optimistic tone. They talk about future rate hikes. They confirm starting tapering in November. If you get these checklist of confirms, bang, you know what I mean? Bang, 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 bang. Gold will have an impulsive drop because the fundamental reasoning behind that is if the Feds confirm tapering, as well as they confirm potential future rate hike schedule, this is all bearish fundamental factors for gold, because this means US dollar will pick up strength, as well as the potential for higher interest rates in the future is a bearish fundamental factor for gold, and the tapering process and regulating the U.S. money supply is supposed to be a way to combat and decrease the macro inflation. And obviously, if inflation is lower or going to be expected to drop lower, this is also a bearish factor for gold fundamentally. Okay? Does that make sense so far? I personally think we're going to get scenario 1, which is going to be first a price grab up to 1830s, then a drop. But scenario 2 is also on the table. Does that make sense? Okay, there's one more scenario that can happen. This is so scenario 1, in my opinion, is the most likely. Scenario 1 being the curveball. Scenario 2 is the second most likely. Scenario 3 I'm about to share with you guys is the least likely, but is still a possible scenario that can happen. Okay? Do you guys want to know what scenario 3 is now? I only see 3 scenarios, but I'm mainly sticking to scenario 1 and 2 happening. And obviously, we're going to confirm this at the actual Fed interest rate decision. We're going to confirm this at the actual Fed interest rate decision. Yes, I'll also confirm the impact on the US dollar and US equities. So anyways, scenario 2, if the Feds make it easy, if the Feds confirm starting tapering, they talk about future rate hikes, they talk about the economy being strong, that will lead us to an impulsive drop on gold, and it will also lead to straight bullish push on the US dollar, right? And the stock market will see a little bit of a drop if they confirm tapering. If the Feds confirm tapering in future rate hikes, this is a bearish impacting factor on the stock market. We might see US 30 dropped about down to like 35,400. Okay? Now, scenario number 3, which I see the least likely. And I'll mark that down as well. Scenario number 3 is the Feds completely backtrack tapering and say there's no taper November and no taper start of 2022. Supply chain issues are too large. COVID risks remain. Economic data is poor. Complete backtrack of last FOMCs. Backtrack scenario. Full fake out scenario. A full fake out scenario will lead to this. Gold pushing up to 1820s because they're completely backtracking and saying we need to keep stimulus active. We're not gonna taper. There's too many supply chain issues. Not enough people are vaccinated. Economic data isn't good enough. Gold's gonna push up to 1820s. It's gonna come to this supply zone. You're gonna have a pullback from the supply zone as a reaction. And then a break above 1830s and continuation up. And gold will switch to bullish higher time frame structure. This is the least likely scenario, but it's still a possible scenario because it's the Federal Reserve at the end of the day. Right? So this would be completely backtracking all of their last months of FOMC. This would be saying we're not going to taper. We're not going to taper in November, and we're not going to taper in start of 2022. We need to keep interest rates low for the time being. We have to keep the economy in an accommodative state. There's way too many issues with supply chain. Job labor market is not where they want it to be yet, and so forth. And gold would go up to 1820s, have a pullback to revisit this previous intraday high, and then start making bullish higher time frame structure, breaking above the supply zone and continuing higher. Because if they completely backtrack, those are all bullish fundamental factors for gold. It means inflation's still going to stay high for the time being. That's bullish for gold. Interest rates are going to be low. That's bullish for gold. US dollar is going to be weak. That's bullish for gold. They still talk about risks in the market like supply chain issues, COVID risks, bad economic data. That's all bullish for gold. Do you understand? I personally think it's going to be scenario 1 or 2. Scenario 3 is the least likely scenario because they can't really keep stimulus active, because eventually if they keep stimulus active and they don't tighten their policy, it's going to lead to hyperinflation. And hyperinflation is an economic risk just as bad as the lockdowns. I personally think it's going to be scenario 1 or 2, which is either going to be they give us a quick curveball just for today and delay the tapering in the short term, and we go up to 1830s and we take those buys up to 1830s, then sell at 1830s the next couple of days. Or they're just going to confirm tapering and we're just going to get a drop below 1760s down. So I'm personally more sticking to scenario 1 and 2, but scenario 3 is on the table and a potential possibility. Okay, does that make sense for everybody? The only way I see gold breaking above the 1830s and creating bullish market structure to start going back up to the 1900s as if the Feds completely backtrack tapering and say that they're going to keep stimulus active, which means inflation is still going to be high. But you have to understand here, when we're looking at various US economic data, like when you're looking at the inflation figures, inflation is very high and needs to be combated, right? So when you're coming here and looking at US inflation, you can see the last time we had a large spike in inflation was during the 2008 financial crash, but inflation still stayed below these levels of around 2.4 to 3. During the pandemic, as they exponentially increased the US money supply, we had a surge in inflation and a surge in the cost of goods for the day-to-day consumer, as well as a decrease in the buying power of the dollar. So inflation is at a point where they should start tightening their policy and tapering. Do you understand? So in terms of when we're looking at criteria of what the central bank needs to start policy tightening and tapering, number one is inflation extremely high to the point that it needs to be adjusted and fixed? How do they fix it? By, of course, starting the tapering process and policy tightening. We can check that off the list. Inflation is extremely high in the US and needs to be regulated and managed by the Federal Reserve's policy tightening, right? Number two, is economic data back to pre-pandemic levels, right? We don't need to see extremely huge labor market numbers. We don't need to see massive retail sales. We just need to confirm that the economic data is back to pre-pandemic levels. So for example, when you're looking at the US non-farm payroll report, right? This is a 20-year maximum we're going to do here in this report, right? This is the US NFP, 20-year maximum, 2000 to 2022. You can see that I'm going to mark in blue. This is healthy median equilibrium ranges for non-farm payrolls data. If you're between these ranges on non-farm payrolls, this is considered normal economic data, considered good economic data. We had a massive drop in labor market, obviously during the start of the pandemic when you had global lockdowns. Then you had a surge in jobs coming out of lockdowns. But now, ever since then, we have been back to regular equilibrium conditions. US labor market data is rebounded back to pre-pandemic levels. Does that make sense? Right? That's the non-farm payrolls. Look at US jobless claims. US jobless claims, 20-year maximum. You can see when we're looking at what is normal economic data, this is the general range here. With this being a massive increase in jobless claims due to lockdown period. But now, ever since the last period of months, jobless claims has been back to pre-pandemic levels. Non-farm payroll, jobless claims, and unemployment rate is all back to pre-pandemic levels because the US has been getting more and more vaccinations and not been in a lockdown. There hasn't been anything to impact the economic data. It's only been improving since then. It doesn't matter if you're not seeing huge numbers. You're not seeing 800,000 in NFP. To see consistent million reports in NFP isn't normal. That was just during when we had the pandemic phase and spike and so forth when we're talking NFP. This is normal figures for jobless claims in the range. The previous chart was normal figures for non-farm payroll. Do you understand? This is my capital hungry Reuters icon, workspace CH. I'm just bringing out these various little applications for you guys. Now, let's look at other US economic data. Let's look at US retail sales. Right? US retail sales on a maximum range here. We can see that on retail sales at healthy levels, normal conditions, this is the median range for retail sales. You had a huge drop in retail sales during the initial fear of the pandemic. Then you had these surges in retail sales that was directly linked to online spending and coming out of lockdowns. But over the last period of months, retail sales is back to normal levels. It's back to pre-pandemic levels. What I'm trying to tell you guys is that economic data has been rebounding and is back to pre-pandemic levels, and there has not been any fundamental catalyst to impact this otherwise, unless the US goes into another lockdown, which is highly unlikely. Right? Let's look at US PMI. Now, the PMI data is different because the US PMI data is graded on an indicator point. Right? So PMI data, for those of you who don't know, is graded above or below a 50 point. 50 is the median grade. That's not the point that you should be at, right? PMI data is, okay, so for anybody who doesn't know, PMI data is the Purchasing Managers Index surveys, right? These are economist surveys and gradings of various sectors within an economy. Right now, we're looking at the manufacturing output sector, the business survey of the manufacturing sector in the US. When you are below 50, this is just a grade point. When you are below 50, this means that economic data and economic conditions are extremely bad. You can see during the 2008 crisis, US PMI and the manufacturing side dropped below 50. You can see during the pandemic crisis, US PMI dropped below 50 in the manufacturing sector. But ever since then, ever since we've come out of lockdowns, we have been at healthier figures. So US manufacturing is looking healthy. US services sector is looking healthy. US retail sales are looking healthy. US job sector is looking healthy, back to pre-pandemic levels. This means that all the criteria for the Federal Reserve to start tapering is 100% being met, and that they should start policy tightening and tapering. Various sectors of the US economy are back to pre-pandemic levels and even a bit better than pre-pandemic levels. Inflation is also extremely high to the point that Feds need to start managing that by policy tightening. Does that make sense for everybody watching? Right? So in terms of when we're looking at the raw economic data and comparing it to historical points, no matter what you guys want to look at, let's look at US factory orders, for example, right? Let's look at US factory orders here. When you're looking at US factory orders, this is healthy figures. being below 4, -4, and +2. These are excluding factors. But when you're within this range on factory orders, this is healthy economic conditions. Right? So various economic data in the US side across the board is back to pre-pandemic levels and is showing much healthier economic data. So when you're looking at what the Feds need to taper, they do have all the conditions met to start tapering. But that's why I see scenario 1 and 2 happening. Because I think that what I personally think is that all the conditions to start tapering are met. We have very high inflation and need to combat that inflation and adjust it. We have all the economic data rebounding, stabilized, and back to pre-pandemic figures. We have more and more people in the US getting vaccinated. We have a decrease in US COVID cases. We have no lockdowns or any other fundamental catalyst that can negatively impact US economic rebound, right? But everybody and their grandma is expecting tapering to start today. I think they're going to delay tapering until the start of 2022 and blame the supply chain issues, and it's going to lead to gold spiking up first to revisit this supply zone, and then the next day or week fading out and continuing down. Or if they just confirm tapering, we'll have easy sells below 1770s all the way down. So I think scenario 1 or scenario 2 is going to happen. Does that make sense to everybody? Yeah, I think scenario 1 is going to happen where everybody's expecting the Feds to start tapering, but they're going to just throw a curveball. They're going to sweep the liquidity out of the market by everybody who's expecting tapering to start, and it's just going to be a price setup. Like I was telling you guys, if you guys rewind this webinar and look at scenario 1, I can see us doing this price setup, having this aggressive spike up to this supply zone, being some short-term buys for today, and then the next day or two fading out and continuing right back down once they get their better sell orders collected. Right? Scenario 2 would be the Feds making it easy. They confirm tapering. They confirm future rate hikes of when they're going to do it. They talk about the economy being strong, and we just break below 1760 and go straight down. I see scenario 1 or scenario 2 happening, and which we're going to confirm by the actual Fed statement release. All right? But anyways, that was just some macro analysis. Let me get rid of this. For the time being right now, gold is creating a support and double bottom at 1781. If we come above 1789s and the Feds confirm that they're delaying tapering, for sure we're going up to 1812s and 1820s. All right. So when you guys are reading the headlines or watching FOMC, if you see the Fed say that they're not starting tapering yet and they're going to delay it till the start of 2022, right? Look for gold buys above 1790s. Above 1800s and 1790s, look for gold buys, as we're going to probably have a run to the 1820s. And then at 1820s, 1830s, start to look for exhaustion by buyers and potential rejection points the next couple of days later for the longer term sells. Because like I was telling you guys, gold retests higher time frame supply zones multiple times before continuing down. It's like what I was showing you guys here. Right? Look at this impulsive drop from a high, break low, you were test the supply zone. You have an impulsive drop, you still retest the supply zone. Impulsive drop, you still retest that supply zone before continuing down. with very aggressive bullish moves that go to retest that zone and get faded out. Yes, if gold, no. If they delay tapering for the time being and gold goes bullish and they say they're going to keep stimulus active, stock markets would still stay bullish. And I'll explain that in a second. No, stock markets would still stay bullish, because what is the main reason stock markets have been so bullish for the last year and a half? What is the main contributing factor? But anyways, I'll talk about stock market in a second. So anyways, you can see that gold sweeps these highs, collects sell orders multiple times before continuing down. Right? Same pattern, same thing you can see here. Very strong supply zone. You get this impulsive drop from a high point. Pull back to these supply zones. And still end up coming all the way down. And you can see every time you come to revisit the supply zone, you have very strong bullish price action in that daily candle or few days that leads up to the retesting of that area. And then as those sell orders get collected institutionally, the algos get activated, and we still maintain the overall sentiment, you fade it out and still have your impulsive move to the downside. So I'm either expecting that Feds are going to throw a curveball, we're going to get a retest of here at 1820, 1830s, then continue down the couple of days or weeks after. Or we're going to break below, or if the Feds just confirm tapering, we're going to break below 1760s and just drop. Yeah, don't worry about ADP. ADP is nothing. You know what I mean? ADP is like whatever. ADP data still showing good job sector. Just like I was telling you guys though, job sector still solid. Okay. Not too much of an impact, just a short-term little spike down on gold, nothing serious. Investors only give a shit about Fed interest rate today. They don't give a shit about ADP. You know what I mean? GJ had a nice little scalp here as well, eh? PPL to PPL. But we'll talk about GJ analysis in a second. Don't worry about that. We'll talk about some scalps. We'll talk about some scalps to take in a few minutes. First, just let me explain now the U.S. stock market impact. So, the only way stock market is going to drop... No, little ego lifter, you got it. Sorry, little ego lifter, you have it backwards. The only way stock market is going to drop and even come down to like 35,400 or a bit deeper for a correction is if the Feds confirm tapering and policy tightening. Because when you're looking at the stock market over the last year and a half, what has kept the stock market so bullish? Is it a bunch of people is it a bunch of people like your mom and dad investing in the stock market? Or what has kept the stock market so bullish? Is it because corporations are performing so well by themselves? No. Is it because your mom, dad, and family are buying stocks every day? No. The reason why the stock market has been so bullish is because the Federal Reserve has literally been pumping the markets. When the Federal Reserve took that money supply, this is the US money supply chart, not the US dollar chart, the US money supply chart, right? You can see just in 2022, historically, 40% of all US dollars in history were printed last year. Please take that in. please let me say that again. 40% of all US dollars in existence in history were printed just last year. That's what led to the massive inflation, right? 40% of all US dollars in history were printed just last year. Yes, go search it up. 40. That's why US inflation is so high, because there's an exponential increase in US money supply. So the feds, they click a magic button, right? They turn on their magic printer. They print out these US dollars out of thin air, right? They print out 40% of the US money supply in a year. You can see this exponential increase. Look at 2001 to 2017. How you are slowly going up in US money supply, and then 2020, boom. Right? What the feds did is let me tell you step by step. The Federal Reserve, every economic crisis is an opportunity for the rich. But anyways, the Federal Reserve, who literally has the power to print money out of thin air, hit a magic button, goes, oh shit, COVID's fucked up, even though they knew all this shit was going to happen ahead of time. You know what I mean? They let the market crash first and come down to significant price points. They let oil crash. They let other commodities have a bit of a correction first. Then when they see the economy is in a crisis state, they flip a switch, they turn on their magic printer, and they increase the US money supply exponentially. Then they take this US money supply and start stimulating the economy. How do they stimulate the economy? Through their asset purchase program and quantitative easing. They start buying up shit tons of real estate. They start buying up shit tons of land, shit tons of commodities, wheat, soybeans, corn, oil. They start buying up every single commodity you could think of. Oil, gold. They start buying up government bonds, corporate bonds, stock market ETFs. They took all this money and flooded the markets to prevent a crash and to also make them more money. Because who do you think was in the stock market from these low points? When they took this US money supply and flooded the market, who do you think was buying at this crash low point? The 1%ers, the whales, the feds, the ultra rich, the smart money, the big bankers, whatever you want to call them. So they let the stock market crash to this point, right? All this injection is to make the rich richer and the poor poorer. Do you understand? Because it's not the poor people, it's not the middle class, it's not the working class who bought real estate during the crash, who bought the stock market during the crash, who bought commodities from the crash. It's the ultra rich who got to enter at sale prices, then ride the wave of the feds pumping the markets. Do you understand? Right? So literally, what's that tell you? That the market maker is the Federal Reserve. If you can learn to understand the Federal Reserve and ride their coattails, you can make a lot of money just by understanding what they're doing and why they're doing it. Obviously it's corrupt. Obviously it's fucked up because, okay, you have to understand. Let me explain this in more detail, right? There is a price to pay when you increase the money supply this much. It's not free. What is the price to pay when you increase the money supply this much? I'll tell you guys, when you exponentially increase the money supply this much, the sacrifice and price to pay, the cost of that printing, is an increase in US inflation as well as a decrease in the US dollar value. So you can see that when the Federal Reserve increased the US money supply, the dollar index did the exact inverse. So who pays this price? When the US increases the money supply, inflation goes up and the dollar value drops. So you have two things happen. The cost of goods for the general masses and people goes up. The cost of goods goes up. But the buying power of every single dollar in their pocket goes down. So there is a major sacrifice when this happens, these economic cycles. Every time there's a crisis, the rich get richer, the poor get poorer. Us, the working class, the average people, the 99%, we are the ones who pay the price for the rich to get richer. And how do we pay the price? Through inflation and cost of goods, through having less buying power with every dollar in our pocket. In a singular year, the dollar went from a value of 103 to a value of 89. At the same time, inflation went up exponentially. Right? So, that's the sacrifice. Whenever they increase the US money supply and do this during a time of crisis, and they pump the stock market and they pump commodities and they pump various assets, the ultra rich benefit from that because it supports their investment portfolios and makes them richer. The sacrifice and payoff, the sacrifice and trade-off, the sacrifice and trade-off is extremely high inflation and a lower buying power value on the dollar. But does that affect the ultra rich? Do you think the ultra rich gives a fuck if milk doubles in price or if the buying power of the dollar went down when they're making millions to billions of dollars on the stock market or buying oil from the lows or being invested in properties from the lows? Do you think they give a fuck about inflation right now? They don't. We are the ones who pay the price. We are the ones who bail them out. We are the ones who pay that money back. Do you understand? So over the last year and a half, you have to understand subconsciously, most consumers haven't even realized this. But if you have millions and millions of citizens paying double the price for their general cost of goods and also the value of the dollar being decreased, that's a lot of money. You have hundreds of millions of people paying double the price for milk, eggs, gas, general cost of goods. You have people having less buying power on their dollar. You have this double whammy of that their dollar has less value in their pocket and their cost of goods is going up. Dollar value is going down, cost of goods prices are going up. This in itself creates a larger gap between the rich and the poor. The rich get richer through this as they're the ones who are buying the stock market. They're the ones who are buying all these commodities and assets. They're the ones who are making money off the crisis, but the middle class gets stomped down even harder. The poor get even poorer. Right? So that's the sacrifice. The Federal Reserve knew that when they hit their magic printer and they increase the supply of the dollar, that it's basic supply and demand. Right? What I mean by supply and demand is that you're going to have an increase in the supply of US dollar and a decrease in demand. The demand is going to be in all of the risk assets and risk investments, such as equities and so forth. So what happens to the buying power of the dollar? The dollar buying power goes exponentially low for that year and a half. Plummets. Dollar buying power plummets. Dollar value plummets. Right? And inflation goes through the roof. Cost of goods prices goes through the roof. Now, guess what? When interest rate hikes happen and inflation is still high during the time, now you're going to have the middle class get triple fucked. How are they going to get triple fucked? Because the US dollar is still going to be relatively lower value compared to where it was a year ago, even if we come to like 96. Inflation's still going to be sitting at 4% expected till 2023, 2024. But when interest rates rise, so does the rates on your credit card bill. So does the rates on your mortgage, your open mortgage. So do the rates on your loans, your car loan, your credit card. So now you have a triple whammy when interest rates rise as well. People will have less buying power of their dollar. Inflation and cost of goods will still be high, but interest rates on their credit cards, loans, mortgages is also going to go up. And this is where people have to foreclose their homes. This is where people have to declare bankruptcy. This is where people go belly under. They cannot play the game of catch up. Do you understand? But the ultra rich, the 1%ers, the people who run the corporations, run the institutions, run the central bank, they don't give a fuck. Because this has been repeating in history every 10 to 15 years. This is the economic cycle that increases the generational wealth of the ultra rich. Do you understand what I'm saying? Does that make sense for everybody? This is the way the game works. It's always constant historical and economic repetition that benefits few, and fucks over the rest. All right? Okay, so now everybody, I gave you guys full analysis for FOMC and Fed interest rate. I gave you guys full analysis about US money supply, interest rates, inflation, dollar value, the impact on the real world, the impact on real people, who benefits, who declines. I gave you guys multiple scenarios for what to expect for FOMC. Now, for the next 30 to 40 minutes, let's do some scalping analysis for some scalp trade ideas with the New York volume as we wait for FOMC later in the afternoon. All right, so now let's just look at our intraday time frames on gold, GJ, GU, Euro USD, UCAD, and US 30, and let's mark up some scalp trade ideas, or let's look for some scalps to take. All right, so just let me give me a second to set up my screens here. Make sure you guys re-watch this webinar as well for anybody who's wondering what we're looking for FOMC. Okay. No, I'm not streaming FOMC on YouTube. I'm going to be doing like a session with the private channel. The private channel, we already did an FOMC planning webinar last night at 10 p.m. We've been ready. You know what I mean? Private channel, we've been ready. Nice GJPY. Very nice GJPY. Good job with GJ, guys. Good call, Sakeem. All right, everybody. Now let's mark out some scalp trade ideas for the session as we wait for FOMC later in the afternoon. We're going to be taking some quick jabs at the market in and out for the next 30 to 40 minutes, and then primarily waiting for FOMC. Okay? On gold, I can still see some potential upside on gold if the new 4-hour candle, we retest 1781 or break above 1789 buys. Okay, let's look at the lower time frame price action here on gold as well. Getting a little bit messy. Also, another set of buys is if we have 1 minute closures above 1780. Okay, so these green boxes are buy areas. Either 1 minute closures above 1785, 1786 for 20 to 30 pip scalps up, or waiting for breaks above 1789, or the retest of 1781 if we don't break lower. Okay? So we're going to be waiting for price action for those areas of interest for some potential buy scalps on gold. Just playing some quick jabs at the market. And we can dig a bit lower than 1781, as you can see this support here. If we do come down here, like come here, then pop back above and take some buy scalps off this level, where we've seen great reaction and bounces off this level for scalps at the 1781 higher time frame key level. All right. On GJ, we can see we've had some. So GJ higher time frames, let's do some analysis. You guys know capital hungry hyenas, capital hungry OGs. For the last year and a half, even when GJ is in pullback structure, what has been my main bias to play on GJ? what has been Jeeves' main bias to play on GJ? Looking for breakout buys, pullback buys. All you've seen over the last year and a half, the same time Japanese yen has been extremely weak fundamentally. And also, you have to understand, from a fundamental perspective, the way Japan's economy is set up and the way their debt structure is positioned, as they are accustomed to staying in negative interest rates, they actually prefer having a weaker yen because it promotes more international business activity and promotes more import-export profits as well, right? So the same time Japanese yen has been individually bearish, when you look at the Japanese yen index, you can see that the same time GBP has come to those crash points, we've only seen this overall upside rally, right? What we saw happen from this strong demand zone I was laying out to you guys in the last market update webinars was we could see after having these highs printed by buyers, we entered a very aggressive pullback stage to collect a lot more buy orders from the 149 price point areas, right? The new quarter at the start of October came to retest this price point and still failed to break lower. Then, as we had continued yen weakness, we had an extremely strong bullish rally from this demand zone all the way up to break these previous highs and create new highs as well. Gold, what? Relax, yo. Gold just back to 1781 again. We're going to watch the reactions at this area to see if we create a little bit of a support and come back above. So don't worry, just relax for the time being. No entries yet. All right. But anyway, so GJ, you can see that from that demand zone, we had a strong impulsive play to break above the highs and peak new highs. As new highs were peaked for the start of November, you can see that we're now creating the monthly lower wick and having a pullback from these high points, which is roughly a 50% correction of the impulsive move. So if we can start to create a bit of an intraday support at this 50% correction area around 155 flat, then I can anticipate us to start making our way back to the upside to target these highs at 158 over the next period of days and weeks. I'm only selling gold below 1772s, and that's going to be maybe later. Right now, I only think gold's going to be bouncing around and ranging from like 1780 to 1785 until Fed interest rate decision. Yeah, you guys are going too crazy. Gold fell like a quick 30 pips. It's not like melting. It's not like dying. It's just dropped in the range. It's not like going anything crazy. Fucking hyenas, man. Vultures, market hyenas and vultures. Okay, so when I'm looking at GJ here, we can see we're actually starting to create that little bit of an intraday support. Okay, what I'm looking at on GJ is if we come down to retest 155.200 buys, or if we break above 155.500 buys. Guy said 30 pips. It's down 50 pips. Okay, and it's not a big deal. It's not like you called the trade there to take. You guys are hyenas, man. It'll probably be back to 1781 in another few seconds. So if on GJ we get a retest of 155.2 and don't break, and also if we come above 155.5, this last rejection area here that brought us back down to these lows and failed to break, potentially creating a double bottom, I'm going to be looking for GJ buys back above those levels. I'm looking at GJ buys at 155.2 and 155.5. Okay, on the lower time frame, I'm going to be looking for breakouts of 155.5. So very nice bullish price action now after having this consolidation phase and order collection on the lower time frame here. Tons of buy orders collected. We broke above 0.200 to revisit these 1 minute highs. Once we break above these 1 minute highs, we can take some impulsive buy scalps for 15-20 pips on GJ. If we don't break above, don't take buys. We need 1 minute closures above this previous rejection point, or we need a pullback to revisit this order block and continue back up. Okay? GBP USD. We can see on the higher time frames on GBP USD, we're still respecting this bearish market structure as the US dollar has been picking up more strength fundamentally ever since the Fed's been giving tapering signals. And we can see a bit of a cat bounce that we're getting from these new lows being printed at 1.36 flat almost. On GBP USD for scalps, I'm going to be looking in these areas at 1.365 or a bit deeper at 3.635 for buy scalps on GBP USD. And remember, all of these trade ideas and potential scalps that can set up are primarily just quick scalps and quick jabs at the market until we are really waiting for the main meat and potatoes, which is going to come from Federal Reserve interest rate. Okay? Now, Euro USD. Same idea, where we're just having a bit of a support and consolidation zone created from these low points, right? Gold melting? What's gold at? Yo, we didn't get, relax, yo. We're not selling here, and there's no buy confirms here. We're just in a range right now in the intraday time frames. Relax, okay? We are not, we're not buying or selling here. Don't worry about it. Just relax. It's not, it's just one hourly candle. Gold moves like this 24/7 every single day. I don't want to be rude, okay? I don't want to be rude, but most of you people can't fucking trade worth shit. Right? I don't want to roast, but most of you people do not have the emotional control or patience to trade worth shit. Every single 15, 30, 50 pip move, you guys fucking lose your mind. Fucking relax. Not a single person in the chat said I'm gonna sell gold. Everybody just said, oh, gold melting. Yo, Jeevan. Hey, Jeevan, gold fucking dropping, bro. Okay, and what do you want me to do? You want me to catch it? You want me to fucking stop? What do you want me to do? Not a single person said, hey, I'm gonna sell gold. Hey, I'm looking to do this. It's just fucking dropped a bit. What do you want me to do about it? Take a fucking breath. And then you wonder why you burn through your account, you overtrade, you over leverage. Because every single 30 pip move in the market, you fucking get a boner. You get rock hard. Just take it easy. Gold literally moves like this every single day, 24/7. Look at this. You guys are looking at this right now. Just take it easy. Right? But now that we're looking at gold anyways, now that we had a cleaner impulsive break below, if we get retest of this area, then I'd be looking for any sells. Otherwise, I didn't see sells in this area. We're still very bullish on the intraday time frames, and I can still see price grabs coming for FOMC later. You know what I mean? Yeah. So yeah, GJ, we're gonna be waiting for the breaks above 0.500, so you can wait for that. Yeah, I'm just Euro USD. Do we just talk about Euro USD or no? No, right? Euro USD, I only see some short-term scalps if we come back above 1.159 to take up to 1.163. Yeah, I'm going to be waiting for breaks above here. Yeah, what I'm mainly waiting for is that those FOMC scenarios I gave you guys. Somebody said, "Oh, you called the sells? Send me the sell you took on my Telegram. I want to see where your entry was." I just want to see like where you're looking at your entry for. You know what I mean? I'm just curious. Mr. MFX11. Send me the trade you took. I just want to see like where you're looking to enter based on what, just out of curiosity, you know what I mean? Okay, UCAD. UCAD is still in this consolidation range that we're starting to show a bit more breakout potential of. Who's this? But on UCAD, I'm still in a buyer bias on short-term buy scalps. If we can retest 1.24 or break above this little resistance here at 1.242. Okay. US 30 scalps at NYSE. I'm going to be looking at potential if we do get retest and just hold this current high point, but we are getting potential deeper pullbacks. I'll be looking at 35,850 buys. Yeah. Remember, these are just some quick scalp trade ideas. We're mainly just going to be looking for some quick jabs we can take at the market if we get those trade ideas to execute on, as we're primarily waiting for Fed interest rate in the afternoon. Yeah, gold, we'll see if we get a retest to this zone, the lows a bit, and get some sell scalps from 1779. GJ, we're going to take buys above 0.500. GU buys at 365. We got that little retest there we were talking about. Euro USD, if we come above 1.159, this little resistance and a price sensitivity area we have here. Yeah, the 4-hour candle is closing in 13 more minutes. Today's webinar wasn't as much of a New York scalping session as it more was prep for Federal Reserve interest rate. Yeah, if you guys want to send me any charts to look at, to like analyze or give my 2 cents, you just have to send me the TradingView code. I don't think you can send the link in the chat. I think you have to send the code. You guys have to send that last like few digits like on the chart code for the TradingView. You can just send me a message on Telegram if you want. I can look at your charts over a Telegram message, or you can send the chart. If you send me the link on Telegram, I can open it. Or if you send me the code in the YouTube chat. Yeah. Yeah, we're gonna be waiting for that. Or if we break below 17s, if we break below these 1 minute lows, there's probably gonna be another sell scalp to 1772 as well. I'm either looking now, adapting to if we get a retest sell or the break below sell to 1772. And GJ, I'm waiting for the break above 156, 155.500, sorry. Okay, some of you guys are sending me some codes here. I think I just gotta do this, right? What is this? Gold. You didn't take this trade, man. That I want to see an actual trade taken, not just a TradingView chart. You happen to take this entry with a 2 pip stop loss, eh? Just right at the tip. Somebody else sent me something. What is this? Who's this? What is this? I've never seen this before. Oh, this is the gold chart. What's this stuff down here, bro? So you took the sell at 1780. Yeah, that makes sense with the ADP being good. Hey, bro, you should use a stop loss. Don't forget your stop loss. GJ take profit above 0.500 would be 155.800. Can we send charts? What? Can we send charts? Good job. What is this you want me to look at? What pair is this? What do you want me to say about this on AUD? What is this? AUD USD? CHF? I don't even know what pair this is. I'm not sure what pair this is. Okay, New Zealand dollar versus New Zealand dollar versus US dollar. You had an impulsive break of a low here. You were looking for the retest and continuation down. This is your 4-hour time frame, retest of the zone. On the 15-minute, you're waiting for a break out of this corrective structure to sell with your stop loss above these highs. That's some good analysis. Who sent me this? Whoever sent me this one, that's some nice analysis. I like it. Very nice and simple, clear cut of what you're looking for. Some intraday time frame with the impulsive break, the potential slower retest and correction, and the lower time frames what you're looking for as well. I like this. Whoever sent me the New Zealand dollar versus US dollar analysis, I like your analysis. Sorry, you guys sent a bunch of codes. Let me open these up. Okay, British pound versus Japanese yen. I'm not the best with understanding. I am not the best with understanding indicators. So I have no clue. I think this is Fibonacci, EMAs, and some other stuff. Some other things. We got a MACD, EMA, RSI. Okay, I don't know. I don't care about any of that. But You are looking for some GJ buys from 155 flat. Okay, that's perfectly fine. It's not really analysis. It's more just you sharing a potential trade you might be in. I don't believe any trades on, if you guys took these trades, that's fine. But I don't believe anybody who just says, oh, I took this trade and they put the trading view indicator on it. I don't believe those. But if you guys like to use indicators and it helps you learn more, then that's perfectly fine. Who am I to judge? I don't give a shit. You know what I mean? You just have to find what works for you and then consistently repeat what works for you day in and day out while managing your emotions and risks. So if some people find advantages using various combinations of indicators and it works for them, hey, and it makes them money, who can tell them otherwise? Ted said, nope, leave me alone. Only I can send Ted analysis in our secret chat. We got a secret VIP community. No, it's $1,000 a month for it's $1,000 a month for the secret service chat, the secret Illuminati chat. Yeah, you can only pay in Bitcoin. Sure, yo, if you guys send me a TradingView code, at Capital Hungry, so I can see your code. Okay, so this is Euro against the Canadian dollar. I also have some Euro Cad analysis here, where I'm looking for sells on Euro Cad below 1.436. Which is the same entry area you're also looking at as well. Roughly, give or take the 10 pips. That would make sense. If we continue to reject those same highs, if oil still stays relatively bullish, then we can see a rejection here, sweep those highs, and continue right back down, as Euro Cad has been in the same range for weeks now. Euro Cad has been in the same range for weeks now. When we're looking here, it's just been ping-ponging in this range for almost 2 weeks. So if we don't clear those highs, I see us coming right back down to the range lows, 1.42900. Uncle Ted took the gold sells based on the ADP data being stronger and breaking below 1785. Uncle Ted's FOMC perspective is probably the same as mine. Yeah, like whatever Uncle Ted sees for FOMC is probably similar to what I'm seeing. But the sell he took was based on stronger ADP jobs data and a break below 1785 zone he had marked out, and then the man executed on it. Okay, oh, GJ starting to break above 0.500 already now. What's this? GJ buys, you took from the 0.200 breakout, TP 0.500. Great trade, Colin. I like that. You waited for the break out of this consolidation range. You took the lower time frame break and retest. Your take profit was set here, and you got your take profit hit range to range. Very nice, very nice. All right, yo, everybody, for GJ entries, don't enter yet. Just wait 2 more minutes for the new 4-hour candle. Okay? Just wait for this 4-hour candle to close. Most likely, we're going to get a little bit of a 4-hour lower wick and then pop back above 155.500 for the scalps during the new 4-hour candle and NYSE volume. All right. What the hell is this? This is the 1 minute time frame gold sell you took? How'd you even take this sell? How'd you have a half a pip stop loss with spread? How'd you do this? What broker are you using? Tell me what broker you're on with like no spread. The stop loss is 4 pips on gold. But I don't have much to say about this trade. I like that you made some profit. I don't really see this as a good trade myself. Yeah, this is some big Al style trading within the singular 1 minute candle. So I'm happy you profited. I don't really see this as like a good setup. You know what I mean? But yeah. Okay, anyways, everybody. I've been streaming for a couple of hours now. I'm gonna go eat breakfast. So far we had that gold drop. I didn't call it, so we didn't execute on anything on the gold sells. We do see the potential for some GJ buy scalps above 0.500, this new 4-hour candle. So keep an eye out on that. Otherwise, just take some quick scalp jabs at the market and primarily wait for FOMC. As if you rewatch the start of this webinar, we did a full FOMC breakdown of what to expect. Okay? So I appreciate you guys coming and obviously giving your support here. Thanks for Uncle Ted for showing some support in the chat and giving people some information in the chat as well. It's been 2 hours now. I'm getting hungry. You know what I mean? I'm starving. I'm going to go eat, end this stream, and then I'll see you guys next time. Make sure you guys rewatch this before FOMC so you can see exactly what to expect with the 3 scenarios we have laid out and the 2 main scenario expectations with Fed interest rate decision and the potential tapering and so forth later on. All right. If you guys enjoy these streams, if you want them more often, make sure to like and subscribe. Last time we needed 500 likes. We didn't hit that. Or did we hit that? I don't remember. If we can hit 350 likes right now, I'll stream again tomorrow. Watch the likes go up. No. Wow, you guys are snakes. There's people took it away. How come I have to bribe you guys to like the stream? How come you guys just don't like it to be nice? It's free. All you have to do is hit a fucking thumbs up. Huh? All you have to do is hit a thumbs up. How come you guys can't just do that to be nice people? How come you have to be bribed? It just shows how selfish society is. It really shows human nature. Alright? He said because we're all assholes. Yeah. Okay, should I do a stream tomorrow or an NFP stream? Most likely an NFP stream probably Friday. If I do another stream, I think it'd be better to do an NFP stream. Right? Friday? I think Friday instead of tomorrow. I think we do an NFP stream instead. End of the week Friday. Yeah? Yeah, Friday, right? NFP. It looks like the chat is mainly looking for NFP stream. All right, everybody. Thank you for watching. Thank you for your support. Make sure you guys check out all the resources in the Capital Hungry description. I'll see you guys next time.